Hello, everyone. This is Louis Navalier. Thank you for attending my presentation on the best dividend and conservative growth stocks. I do want to apologize for not being there in person. I did break my leg a little more than 3 weeks ago, and I've had a couple surgeries, and I'm still got my foot up in the air and living in a wheelchair. So I did intend to be there in person, so I apologize that I have to do this on via video, but I'll do a good job, and I got a great presentation for you. So before I get to the best dividend growth stocks, I just want to mention a couple quick things here. First thing is we're going to show you stocks that we actually have under management and we buy for our clients. I own all these stocks personally, so is my family. So we really do believe in the stocks we're about to show you. For those of you who get our investment newsletters, I do want you to know that our investment management is different than the newsletter business. If you're ever interested in our investment management, we'll give you a separate performance data based on the actual performance of our managed accounts and all. So basically, don't use our newsletters to evaluate our management services. Okay, so let's talk about our Fed's dilemma. Our Fed is probably going to be cutting interest rates on the just before Halloween, and the reason is we've had some weak economic data come out on inflation, on wages actually fell in the last month a penny per hour, and the Fed never fights market rates, so their job is to uninvert the yield curve, but they don't want to fall in this black hole of negative interest rates. And I'm going to talk about why we have negative interest rates around the world and what's causing it all. So this chart shows you that a year ago, the yield curve was perfectly normal, okay? And that meant that short-term rates were lower than long-term rates. But it did invert, and it has been inverted for some time. And the Fed wants to uninvert the yield curve. And the main reason they want to do that is simply due to the fact that an inverted yield curve destroys the banking system that they regulate. So we're not very pro-bank. If you're going to buy any financial stock, we'd rather you buy a stock that is not sensitive to the yield curve. So that could be like a company doing mortgage insurance or things that do payment processing, the MasterCard, the Visas of the world, the PayPals. We have a company called PaySign that makes the little prepaid cards. They're also often used in the healthcare industry. Paycom's another one. PAYC does payroll processing. So we do not like financials, and the Fed knows that an inverted yield curve destroys banks, so they will be uninverting this yield curve. So let's talk about what caused the negative rates, and it's largely Europe. Okay, it's Europe's fault. The outgoing director of the European Central Bank, a guy named Mario Draghi, an Italian gentleman, he basically believed in something called modern monetary theory. And what modern monetary theory meant is he could keep rates negative as long as inflation didn't materialize. So he could do endless money pumping. And so they pumped so much money and boosted their quantitative easing, they have negative rates all over Europe, even in obscure little European countries like Bulgaria, Malta, okay, Cyprus. Some of these countries I mentioned, especially Malta and Cyprus, are known to launder money for Russians and things, and they have negative yields. So can you imagine that you go put your money in a bank and they're going to pay you negative yields? So, and in places like Germany, yields are negative everywhere. So there's over 16 trillion in negative yielding debt now, thanks to Japan and Europe. And that is why the dollar is so strong, and that is why our interest rates fell in America, because capital moves all over the world, and the rest of the world deemed the U.S. much more attractive. We have a stronger economy, we have a more hawkish Federal Reserve, and we do have a strong leader in President Trump. So this next slide, slide 6 here, kind of shows it all. It shows that the U.S.'s yields are on top in red, and then we show yields from Britain, Sweden, Japan, Germany, and France. And I will add that Britain's yields are positive now. They're getting ready to leave the European Union at the end of the month. We do hope Brexit happens October 31st because we want to get rid of all that uncertainty. Right now, they're negotiating with the EU on what it will cost Britain to leave, and that's been the sticking point why they haven't left. But when Britain leaves, it's really devastating the EU. I do expect the euro to be at parity with the dollar sooner than later, sometime next year in 2020. So, as their rates go down, they pull us down. It's as simple as that, and you can see the correlation in these charts. Okay, so this is how the negative yielding debt has been growing around the world. This is from Bloomberg, and we're over 16 trillion rising. And we have big multinationals in America, like Apple and Google, that go all the way to Germany. They'll sell 6 to 9 year notes, actually 7 to 9 year notes. I'm sorry about that, 7 to 9 year notes, yielding 60 basis points, barely 60 basis points. So U.S. companies will go borrow money extra cheap in Europe. You may know that when our corporate yields fell, a lot of big companies sold 30-year bonds. They were Apple, John Deere, and United Airlines for one. They all were able to sell 30-year bonds less than 3%. So basically, when you have these low rates, you tend to have higher price earnings ratios. And a lot of companies will sell debt, both in America and internationally, and they'll use this money often to buy their stock back. So things are pretty cheap right now, okay? And this next chart on page 8 here shows you that financial conditions around the world are very, very loose, okay? And our Fed is the slow one, okay? Our Fed is playing catch up with market rates. So we do expect the Fed to cut interest rates a quarter of a point at the end of October, just around before Halloween. And then also, we also expect them to probably cut rates at the December meeting as well. As you probably know, President Trump has been pressuring our Fed to cut rates faster. He's even would like to have negative rates himself here in America. That will not be happening. So obviously we have 20 plus trillion in government debt. President Trump would love to refinance it, negative yielding debt. He's a real estate guy. He's not going to get his wish. Our Fed is independent, and they have to do it based on the economic tea leaves, and they do not want to go the course that Europe has gone. The other reason this happened in Europe was demographics. Europe's a lot older than America. After World War II, they were cleaning up, and we had a baby boom, and we're just naturally younger than them. Also, our immigration works better. I know immigration is a hot topic, but obviously the immigration in America works better than it does in some other European countries. And so the median age of our households is lower. And but what happened in Europe, they just got so old, and they didn't have the guts to tell everybody that they're going to cut their benefits. So guess what? they just printed money because they haven't got to tell people they can't pay them. So their currencies are eroding, their money's eroding, and what a mess! Just what an absolute mess. One last thing about Europe, just so you know. Mario Draghi's replacement is a gal named Christine Lagarde. She used to run the International Monetary Fund, and she's the one that put a Band-Aid on Argentina. And you may know that Argentina got a big loan from the IMF, and that's a big concern, but their currency just collapsed 35% in the last couple of months. So it doesn't give me any confidence that the gal that to put a Band-Aid on Argentina can fix the Eurozone and the European Central Bank. So it's very, very interesting. And the European Central Bank is very political. Obviously, the whole Euro idea what came out of Germany, the Bundesbank. But then even though the Germans might have had the idea, they don't let Germans run it. And so they had Jean-Claude Trichet, who was a French guy. You may know he had some problems in New York with a hotel maid. It was unfortunate. Mario Draghi, It was the Italian guy running it. Now we have another French person going to be running the European Central Bank. So, which is Christine Lagarde. So, the Germans and the Bundesbank are just aghast that the rest of Europe won't be German and exert fiscal discipline like Germany does. So, what a mess! What an absolute mess! So, all this global capital that's sloshing around the world has decided that America is the place to be. Okay. And these are two charts that show the strength of the dollar. And you can see the dollar versus broad baskets of currencies is at or near a high. We have two different definitions here of the US dollar strength on page 9 here. But clearly, the dollar is king. And this has a big impact on our stock market because half the sales of the S&P 500 come from outside of America. So a lot of big multinationals are being paid in eroding currencies. Furthermore, commodities are priced in dollars, so when the dollar gets strong, it squelches inflation. And actually, if you look at the producer price index, we actually had deflation last month. It's so the lack of inflation is another reason our Fed can cut rates. Now, everybody wants to fight deflation. Germany's slipping into recession now. It isn't official yet, but it will be official soon. They contracted in the second quarter. Their manufacturing is very weak right now, so is factory orders. Obviously China slowed down. The world is not hitting all cylinders right now, and that will also keep interest rates low. But here in America, thanks to strong consumer spending and record energy exports, which shrinks our trade deficit, we're going to continue to grow at 2+% GDP growth, even though our manufacturing in the United States has also slowed down a bit. Of course, the GM strike does have that impact. On page 10, we show you that domestic stocks have a huge edge over multinationals. And of course, the US stocks are just doing better than a lot of international stock markets. And this is very simple. We have a strong currency. These other countries have eroding currencies. So I'm very, very bullish on domestic stocks, especially ones based in the US. So let's talk about the upcoming earnings announcement season. It's kicking off this week, and the financials kick off initially, but then you'll get some non-financials in a few days. So let's talk about what to expect. First of all, I don't want you to worry because we're now in the seasonally strong time of year. Believe it or not, October has been a good month in the last 20 years, 50 years, and 100 years. Now, I know some of you are skeptical because it says October wasn't good last year. That's correct. And October wasn't good in October 87. But on average, in the last 50, 20, and 100 years, October is a good month. And you can see in the last 20 years is really good. But November, December are also good, okay? So this is a seasonally strong time of year. Now, I want to explain to you why it's better in the fall. One reason is the holidays come. And people tend to be happy during the holidays. They gather with friends and family for football and food, and it's just a happy time of year. And when we're happy, investors are happy. Furthermore, we often get new pension funding late in the year. We get more pension funding in January. That causes a January effect, but often we get an early January effect in early November and sometimes even in October. So I just want you to know the seasonally strong time of year is here. And so I want you to enjoy it. And in the next 3 to 4 months should be excellent. This is from the Atlanta Fed, page 13. It shows you GDP growth, what we expect. And basically, right now the Atlanta Fed's below 2%, but don't be surprised if it goes over 2%, because consumer spending is very robust. Last week we had the Michigan Consumer Sentiment Index, had a big jump, so that's a good sign. But look at the S&P 500. Thanks to a strong dollar, they keep cutting their earnings estimates for the S&P. Now, some of this is the global economic slowdown. Some of it is also year-over-year comparisons are difficult. But I want you to know right now you are in the trough of the S&P 500's earnings. They've been very, very difficult the last few quarters. Sales have been growing faster than earnings. Margins have been under compression. One of the things we do at our management company and our newsletters, we always make sure that earnings are growing faster than sales due to margin expansion. But this is the trough of earnings. They're only going to get better going forward. A lot of it has to do with year-over-year comparisons. You see, over a year ago, a lot of companies were still benefiting from the windfall tax cuts that President Trump passed. And so just the year-over-year comparisons are tougher. But they're going to get easier in the upcoming quarters. So if you want to buy when the earnings are at the trough, now's the time. And I want to talk to you about the earnings deceleration. On page 15 here, we show you the earnings growth for the S&P 500 on the left side. So you might see in 2018, the S&P 500 earnings grew at 23.8%. In 2019, they grew, our forecast grew at 1.9%. But if you can see in 2020 and 2021, they're supposed to be growing over 10%. So again, this is the trough of earnings for the S&P 500. They will only get better going forward. And one last thing, elections tend to be good for the stock market because in a presidential election cycle, the candidates run around and promise us everything and anything, and that seems to run off on both consumer sentiment and the market. So we will rally going into the November elections. Now, the market's been pretty firm since last Wednesday because that's when the Trump administration said they're not going to be cooperating with the House impeachment inquiry unless they vote for formal impeachment investigations. If they do vote, then you can have a defense. Right now, what the House is trying to do is they're trying to stir the pot. They didn't like the Ukrainian transcript of that call transcript, so they insinuated it was something else, and so they're really kind of stirring the pot right now. But the truth of the matter is that President Trump said he would cooperate. Okay, obviously turned over the Ukrainian transcripts, but only when there's an official vote, because then they can mount a defense. So obviously this is political posturing and things like that. And but the market's been rallying ever since the Trump administration said they will not cooperate with the House until they hold an official vote. So take that for what you think. A lot of people think it's helping President Trump raise a lot of money, might help his reelection chances. Okay, I don't want to scare you with page 16 here, but it does show you of the 11 sectors of the S&P 500, only 2 are supposed to have positive earnings this quarter. So you are not in a sector market now. You are in a stock picking market, okay? And healthcare as an industry seems to be worried about Bernie Sanders, Elizabeth Warren as their leading candidates. This is normal. Healthcare didn't like when Hillary Clinton was running. They were scared of her too. So so that's a problem. Okay. So what I need to do as a manager is go and cherry pick the best stocks in all the sectors. So you are now in the stock picking market. You are no longer in a sector market. And just so you understand, when earnings come out, they tend to be better than expected. We happen to show the quarterly earnings of the S&P 500, what the estimates were for over 3 years versus the actual earnings, and you can see every single quarter the S&P 500 has announced better earnings than the analysts estimated. So even though the analysts are estimating a 3.8% earnings contraction, they'll probably be flat, even up slightly. So I just want you to know that. So where do you turn? I mean, this is a very confusing environment. There's obviously you got bearish people on TV trying to scare you. You've got next to no earnings now on the S&P, and you got very low interest rates. So where do you turn? So we think where you should turn are dividend stocks, especially dividend growth stocks that will benefit from the ultra low interest rate environment we're in, as well as very good growth stocks will post much stronger sales earnings than the underlying market. All right, before I show you the stocks, I'm about to show you the stocks. I know you've been very patient waiting for them. I do want to just discuss why the stock market has such a good foundation under it. And that has to do with the S&P 500 dividends and stock buybacks. The chart in green shows you for the last 20 plus years that dividends have been steadily rising for the S&P 500. So that means the foundation is better. Right now, the S&P yields over 2%. The 10-year Treasury is a little over 1.7%. It's very rare for the 10-year Treasury to yield less than the S&P 500, and that's a screaming buy signal. Even more than that, a couple months ago, the 30-year Treasury yielded less than the S&P 500's dividend yield for the first time in 11 years, and that was a screaming buy signal. So you can get out of the market and you can get interest income, but you'll actually get less than if you stayed in the market. Please remember your interest income is taxed at a max federal rate of 40.8%, while most of your dividend incomes can be taxed at a max federal rate of 23.8%. So you actually get more income staying in the market than being out of it. The other thing is this ultra low interest rate environment has resulted in record stock buybacks. And some in the media will tell you, oh, buybacks are shrinking, they're going down. Yeah, they've slipped a bit, but can you see they're still near a record high? Do you know the S&P 500 will be gone in 20 years approximately at the current stock buyback pace? So the foundation of the market is very good. The dividends are high, the buybacks are still very strong, and believe it or not, the physical stock market is shrinking. And dividends should continue to grow. Companies do, if you look at their retained earnings, as they retain more and more earnings, they tend to pay out higher dividends. So I love dividend growth stocks, and I'm going to give you some of my best here in a moment, but I love dividend growth stocks. Here's an example on page 21. We show you that the dividend growers do better than dividend payers. So I just want to spend a little time explaining this to you. At my management company, we run 3 different types of dividend portfolios. First is power dividend, which yields 3.7%, and those dividends double every 6 to 7 years. That is actually our safest dividend portfolio. It's the least volatile. It's the only one that was up in 2015, which was a tough year for the dividend stocks because a lot of the energy paying dividend stocks had a bad year. So power dividend is what we like. Yields 3.7%, all qualified dividends. We have a concentrated high dividend portfolio that yields 4.3%. It's a little more volatile than power dividend, and you won't have the dividend growth behind it. But if you want a higher dividend yield, that's another excellent option. And finally, we do MLP REIT portfolios for people. We don't have a lot of energy stocks. I know I'm talking to you folks in Texas, but we don't have a lot of the energy stocks. They're having a tough time now with low natural gas and crude oil prices. When we do energy stocks, we tend to have terminals, pipelines. They tend to go on the volume, and fortunately, we have record energy production and exports right now. But I can get a yield over 8%. I had one client come to me. I got him a 9.38 yield. I handpicked approximately 14 high-yielding stocks for him. So, but those, when we do a REIT MLP portfolio, that's going to be taxed at up to 40.8%. So I just want you to be aware of that. But dividend growth is better than the high dividends, and this is just evidence of it. Okay, so how do we find all our great dividend stocks? Well, guess what? We have a dividend grader, and it's free online to you. So here's how you find it. You can go to Navalier.com, which is our management company headquartered in Reno, Nevada, or you can go to NavalierGrowth.com, which is our newsletter site, and that's out of Baltimore, Maryland. Whether you're on our NavalierGrowth.com or Navalier.com, we both have the dividend grader there. And this chart shows you our dividend stocks ranked on an A, B, C, D, and F basis. Obviously, the A-rated dividend stocks are the best. I tend to buy them when they're A's, and they'll often slip to a B after several months, and then usually when they're C or so, I'll be selling them. But we want to keep you, and I'm going to give you some great dividend stocks right now. They're all A-rated. But take advantage of our dividend grader. You can go to our websites, again, at Navalier.com or NavalierGrowth.com, and you can key in your dividend stocks and see how they rank. And hopefully you just have A's and B's, which we call strong buys or buys. But if you have some D's and F's, I would definitely look at maybe selling them to buy something better, because you can see when they're ranked at D and F, they don't do so good. So here's my 5 dividend stocks I want to give you tonight. I want to talk about them a bit here. Arbor Realty Trust is based in Uniontown, New York. They do bridge loans to REITs and things. They have an 8.52% dividend yield. It's A-rated. I've had this stock for some time. We more than doubled our money in already, but it's still highly rated. Great Ajax. AJX is new, A-rated, kind of thinly traded, so be careful. Don't chase it. But it gets a coveted double A. It happens to be an A in our stock grading database as well as our dividend grader. And I usually find 4 to 5 AA rated stocks a month. And Great Ajax is one. Coca-Cola European Partners is a bottler in Europe, symbol CCEP. It is A-rated, but you notice the dividend yield is only 2.2%. But this is a good example of a dividend growth stock. CNX Midstream Partners is one of the few energy stocks I have. They're obviously in the terminal and oil and pipeline business. That's a healthy business. They yield 10.49%. So, and it's A-rated right now. And finally, we like Capital Southwest, CSWC, another A-rated stock. In fact, it gets an A-rated in all the categories. It's the only stock here that gets an A in all the categories I'm showing here. So, and it yields 7.18%. So these are examples of dividend stocks that have popped up on our dividend grader. They end up in our investment newsletters. We have elite dividend lists on our growth investor letter. They end up in our managed portfolios. We have power dividend, concentrate high dividend, and then we do REIT MLP portfolios as well. So if you need yield, we know how to get it, and it all starts with our dividend grader. So those are our 5 best dividend stocks. Now we got to show you 6 growth stocks. But before I show the growth stocks, let me show you where they come from. First of all, a little bit about growth in general. We have the S&P 500 here, and the growth stocks are in red, and the value stocks are in blue. And you can see that value stocks have been performing poorly since 2009. What are value stocks? Financials is one. Companies don't have earnings growth. So folks, if you're a great American, I hate to tell you this, but you got to buy nothing but growth or dividend growth, period. We are not value managers. We don't believe in value management. And I hope you can clearly see here that growth is better than value since 2009. Okay, and here's some of the growth categories for you. What we have here is we're showing you large cap growth, mid cap growth, small cap growth. We've highlighted the boxes around those, and they are the leaders, okay? They're the ones that do the best. Small cap actually led the way, followed by mid cap, followed by large growth. And then there's the large value, mid value, and small value. So I want you to go growth no matter what asset category you're in. Simple as that. There's also something out there called a PEG ratio. PEG ratio stands for price to earnings to growth ratio. It's near a record low now. So when you buy growth, you actually are paying some of the lowest price to earnings ratios I've ever seen. Also relative to interest rates, stocks look dirt cheap. I do want to explain to you where P ratios should be when we have low rates. So if the 10-year treasury was 3%, the average P ratio should be 33.3. If the 10-year treasury was 2%, the average P ratio should be about 20. The 10-year treasury is a little over 1.7%, so the average P ratio should be about 60, plus or minus estimated growth looking forward. So we are not at 60 times earnings, okay? The market is nowhere near that. In my opinion, the market could almost triple and still be fairly valued relative to interest rates. So we are grossly undervalued by all historical standards. And so don't be scared of the market. Don't let the bears scare you. They're just trying to sell you some alternative investment. That's why they're trying to scare you, just so you know. Okay, let's talk about our stock grader. We launched our stock grader back in 2007 when I did a book. It was called The Little Book That Makes You Rich. We did it for John Wiley and Son. It's actually a little handbook on how to use our stock grading. You can find our stock grader at Navellier.com. That's Navellier.com. That's for our management company in Reno, Nevada. Our newsletter site, NavallierGrowth.com, calls it Portfolio Grader, but it's the same database. And we rank stocks on an A, B, C, D, and F basis. An A-rated stock is a strong buy, a B-rated stock's a buy, a C is a hold, and a D and F. D is a sell, and an F is a strong sell. I like to call D's dogs and F's dogs with fleas. Okay, so we use this stock grader to find all our great growth stocks. Obviously, I'm going to give you predominantly A-rated stocks right now. So let me go ahead and give you some of the best stocks. Okay, so we have Archline Capital Group, ACGL. This is a reinsurance company, okay? And believe it or not, even though hurricane season is not over, it hasn't been a bad season so far. It was devastating for the Bahamas, but the big storm missed South Florida and went on to hit South Carolina, North Carolina. I know south of you in Houston, you had some really bad weather events that hit Houston and Beaumont. We're not out of hurricane season yet, but because the natural disasters have been less than they estimated, this helps Arch Capital, ACGL. Furthermore, they have a big bond portfolio. As bond yields go lower and lower, makes their bond portfolio go up more. But this company has very good sales and earnings, and it's one of our top growth stocks. Cadence Design is another one, the symbol is CDNS. You can see it's an A-rated stock. It's in our growth investor letter, as is Arch Capital Group, looking great. Chipotle Mexican Grill is also an A-rated stock. CMG is a symbol. And believe it or not, outside of Texas, they don't always have the best Mexican food in many parts of the United States. So what Chipotle has done is they're a real big hit with the kids and millennials. But the other reason they're so successful is that you just can't get good Mexican food in many parts of the United States. Now, obviously, Texas is an exception, as is New Mexico, Arizona, California. But, if you live in North Dakota, you might get better Mexican food from Chipotle than you would elsewhere. So this is a very successful company. It has regrouped and is capturing tremendous market share. Now, Lululemon is a B-rated stock right now. The symbol is LULU, but this stock has beaten analyst estimates for 15 quarters in a row, and I really like it. You probably know that they are famous for getting everybody to wear yoga pants, but their sales growth is actually coming now from men, especially high school kids. They supply a lot of high school kids with shorts and t-shirts and socks. They're very much more comfortable, and so it's expansion into menswear and they're conditioning the kids at the right age. So Lulu's a great stock, and I expect to have very good earnings, another round of good earnings from it. Viva Systems is another software company we like. It's an A-rated stock, VEEV. It's a very safe stock for us. And then we also like ZTS Zoetis. This is more of a veterinary medicine a company. So if Bernie or Elizabeth Warren get elected, I just want you to know it's not going to affect them, because to my knowledge, they aren't going to be regulating the drugs to your pet. Okay, so they are immune to all this, and those are my top 6 growth stocks for you. So I've given you 5 great dividend stocks, 5 great 5 great dividend growth stocks, 6 great growth stocks. Almost all the stocks are A-rated except for Lululemon, and I just feel really, really good. So it's time now to take some questions, and I got to see here on the internet how all this works. Hold on here. I'm looking here to see if we've had any questions, but but I do have a few questions other people have sent me, so let me go ahead and answer them. And then if our hosts here at Money Show know how to send questions to me, I'll answer them live. I think I got another 5 minutes or so to talk to you folks. First of all, let's start with we have a question from Ralph here about negative interest rates. When are we going to have negative interest rates in this country? Greenspan already said they would. That's not going to be happening in my lifetime. It's not going to be happening in Alan Greenspan's lifetime either. He's over 90. I think what happens is Greenspan said that just to get attention. You know, he gets professional speaking fees, but we do not anticipate negative rates, even though President Trump would like to refinance all our debt of negative yielding rates. That will not be happening. You know, we have an independent central bank. They're very feisty, and they're not controlled by the president, even though he's trying to influence them. We have another question here: is aren't small caps more volatile than the mid and large cap stocks? And the answer is yes. Okay, but there's two types of volatility. There's up volatility and down volatility. And you are now entering the seasonally strong time of year for both small and mid cap stocks. It really starts in the third quarter, and it usually runs through April into May. So as long as you don't mind up volatility, I would have some definite exposure to small and mid cap now. In fact, I did an allocation for somebody the other day. He was a fairly aggressive person, and we literally had him 45% small cap and 55% large cap. So if you're going to tweak this allocations, you want to tweak it around May because the markets get a little bumpy in the summer months. So we'll see. Here's a good question here. Why don't I have more energy stocks? Well, you know, it's just incredible what's happened thanks to Texas, North Dakota, that you've made us energy independent. Did all the fracking in the Permian Basin. We are now the biggest exporter of crude oil in the world. That happened in June before the tax on Saudi Arabia. But you know, it's the companies themselves just aren't posting the sales and earnings growth that I need. And you know, energy prices are very soft right now. There are more people in the northern hemisphere than southern hemisphere. So what happens when the fall approaches is worldwide demand for energy drops, and that's what's happening now. In fact, according to the Energy Information Administration, crude oil inventories have risen 4 straight weeks in a row, even though it's the fall. Long term, you know, the worldwide switch to electric vehicles may cause peak oil demand. You know, Europe is pushing electric vehicles big time, led by Volkswagen Group, Mercedes, and BMW are also right there behind them. The reason they're doing that, you can't drive to some city centers when the pollution monitors go off. You have to have either a hybrid or an electric vehicle. And you know, if you've ever been to California, the reason they have electric is you get an HOV lane free. I happen to live in Palm Beach County, Florida. We have the same thing. You know, we can get an HOV lane with a hybrid or electric vehicle. And so that's also motivating a lot of us, but Europe's leading it right now. I know in Texas that that's not fully happened yet, but it's happening around you. So it's here to stay. And I'm not even sure that anybody's going to make money in these electric vehicles. Dyson, the vacuum company, spent $2.5 billion trying to build an electric vehicle and just pulled out. We're very worried about Tesla. I'm not sure they're going to make it because they're still not making money. The Reno battery plant's out not that far from our office out there, and they stopped expansion. Panasonic's not making money. That was featured in the Wall Street Journal recently because the Tesla plant's half Panasonic. And Tesla's trying to move its outsource to China as fast as they can. It's interesting. Volkswagen will have about 25 electric vehicles in the next few years. Volkswagen, just so you know, is Audi, Porsche, of course VW. There'll be an electric van. That's good. A lot of people are going to be interested in it. So the electric cars are coming, and you know, how fast they'll hit Texas, we'll see. You guys drive a little farther than the rest of us. Okay, here's one more question, and I have here to answer. And the answer is, how much are we going to be up in 2020? Well, that's a good question. My average growth stock has over 28% earnings growth, but we do have some PE ratio compression usually. So I would guess that we would be up anywhere from 16 to 22% next year, just following the forecasted earnings. Of course, my stocks tend to have earnings surprises, so maybe I'll do a little bit better. But again, election years are good for the market. Everybody runs around and sucks up to us. It's going to be totally different this time because President Trump has a lot of money, and we don't expect the impeachment to go through, mainly because they don't have any evidence, and he turned over the transcript, and they didn't even read it because it didn't say anything. So they're trying to impeach him through innuendo. That's not going to happen, and they just don't have the witnesses to do it. So, and of course, even if the House tries to impeach him, the Senate's going to block it anyway. So I think they're trying to take the guy out because they know he might win. So we'll see what happens. But it's unfortunate when they did the House impeachment inquiry, they took out Joe Biden effectively because they exposed his son Hunter, who's been resigning from boards and things. So we'll see what goes on here. So I'm not sure we're going to have much of a presidential race, but we'll see who emerges. Down here in Florida, this guy Yang won the straw poll. He wants to give everybody 12 grand a year in universal income. He also wants to have a value-added tax. But maybe if Yang wins Florida, I don't know. We'll see how he does after Super Tuesday. So that's basically all I have, folks. I hope you realize that the markets are narrow now, that it's a stock picking environment. We use our dividend grader and stock graders to cherry pick the best stocks for you, find those great A-rated and occasionally B-rated stocks. So I'm here to help you. I apologize I couldn't be there in person. I did not intend to break my leg. I had a bicycle accident. It was pretty good. And I've had a couple surgeries and I have one more to come. So not quite out of the woods yet. But I definitely couldn't be there with you, but I'll be there with you next year. I'll be at the Money Show in Orlando. So keep all your good questions coming. This is Louis Navellier. Thank you very, very much for attending our webinar. And I look forward to seeing you at the next Money Show in Orlando. Take care, everybody. Louis Navellier.